Hello, and welcome to my video on long-lived assets, asset turnover, and the return on assets ratios using PepsiCo's 2019 annual report. You'll see on PepsiCo's 2019 balance sheet, long-lived assets are after the current assets. They consist of property, plant, and equipment of $19.3 billion, amortizable intangible assets, which $1.4 billion, goodwill, and other indefinite-lived intangible assets of $30.1 billion, which are the biggest part of the long-term assets. We also have investments in non-controlled affiliates. We own an ownership stake, not enough to control it, of about $2.7 billion. If we want more details about, well, what types of property, plant, and equipment do we have, and what are their ages, we can look in the footnotes. In Note 4 of PepsiCo's 2019 annual report, Form 10-K, has details for property, plant, and equipment and intangible assets. For PepsiCo's net property, plant, and equipment, which I'll abbreviate PP&E, of $19.3 billion, it has a historical cost of $43 billion. This includes land, not very much, $1.1 billion, buildings and equipment, $9.3 billion, machinery and equipment, that had the biggest cost, and construction in progress. Notice that the lives are anywhere between 5 and 44 years. Accumulated depreciation is the sum of all the total depreciation expense to date on buildings and improvements and machinery and equipment. Any depreciation taken ever to date is subtracted from the historical cost of property, plant, and equipment. So the $24 billion subtracted from the $43 billion gives us about $19 billion. Depreciation expense this year on the income statement is either in cost of goods sold if we used it on machinery and property, plant, and equipment used to make finished goods inventory, or selling and administrative expenses. Note 4 also tells us details about both amortizable and other intangible assets. Net amortizable intangible assets of $1.3 billion are acquired rights with limited lives, mostly franchises and brands. Note 4 shows the estimated of the average life for those intangible assets, those rights, are somewhere between 5 and 60 years. The historical cost of PepsiCo's franchises, brands, and other intangibles is available. It's at $3.1 billion. Some companies just report the net amount of intangible assets. PepsiCo actually gives you the historical cost and separates out the $1.655 billion in accumulated amortization, which is the sum of the amortization expense from the very first time you used it till today. So we get the net amount of $1.43 billion. This year, we're amortizing them slowly. There was only amortization expense of $81 million. And as a matter of fact, they even tell you what they expect amortization expense to be: $82 million in 2020, $80 million in 2021, etc. The reason why these are so small, they're assuming that they don't acquire any other limited lives intangible assets. If they acquire more, that might go up. So we said the indefinite life intangible assets are those that are not amortizable. It's larger than the sum of net property, plant, and equipment and amortizable intangibles, so this $30.1 billion. Note 2 on accounting policy states that indefinite-lived intangible assets and goodwill are not amortized, but we assess them for impairment annually using a qualitative or quantitative approach. So we expect these to have a source of value for a long time, but just in case they start to lose their value, we test to make sure that they are at least worth what we valued them at when we acquired them. Goodwill, which is very specific definition, it's not your customers liking you or customer loyalty. It's a very specific accounting definition. It's the biggest part of this, $15.5 billion. That's when one company acquires another and pays a purchase price exceeding the fair market value of the individual net assets acquired. Some of these individual net assets acquired, like brands, can be either limited life or indefinite lived intangible assets. The other non-amortizable intangible assets are $14.6 billion. in management discussion and analysis, they talk about some of these are mostly brands that are not developed in-house. Let's say, for example, they bought Gatorade, the brand, instead of buying the company that owned it. As an example, I'm not sure that's true. But they intend to support these brands, and they say in the management discussion analysis, we believe that a brand has an indefinite life if it has a history of strong revenue and cash flow performance, and we have the ability, the intent and ability to support the brand with marketplace spending for the foreseeable future. So if you buy a brand from somebody else, it can be a long-lived intangible asset. If you make your own brands in-house, which Pepsi also does, forget it. That's not on your balance sheet. As a matter of fact, all the advertising expense you spent to build that brand is already gone into expense in the past. So only when you buy another company's brand would you see that here. Let's look at the ratios that we're going to use with assets and including those long-lived assets. So asset turnover is a measure of efficiency. It's net sales over average total assets. We need this year's income statement and this in last year's balance sheet. So we take net sales from 2019, 67 billion. Average total assets is total assets at the end of 2019 plus total assets at the end of 2018. Average them, summing and dividing by 2. If we take 67 billion divided by average total assets of 78 billion, we get asset turnover of 0.86 times. Notice that we did this also for 2018. I'm only asking you to do it for 1 year for your companies, because in order to do it over 2 years, you'd need an earlier annual report. So to get the 2017, end of 2017 total assets, I could get it from the 2018 annual report or the 2017 one. So in 2019, PepsiCo generated 86 cents of sales dollars per average dollar of assets invested. Higher asset turnover indicates more efficient use of assets to produce sales, and given that sales have a positive profit margin, you'll have higher profitability if you have higher asset turnover. Using asset turnover, PepsiCo is more profitable in 2019 than in 2018 because it generates 86 cents in sales per average dollar of assets invested versus 82 cents in sales per average dollar of assets invested. So it's a little more profitable, just slightly. Let's look at return on assets, another ratio in the chapter on long-term assets. So we take net income we're looking at that for common shareholders. After deducting income attributable to non-controlling interest or preferred shares, we look at assets at the end of this year, 2019 and 2018. In 2018, we need assets at the end of 2018 and the end of 2017, for which we'd need another annual report for the assets at the end of 2017. We average the total assets, sum them up, divide by 2, and we get a return on assets of 9.37% for PepsiCo in 2019 versus 15.9% in 2018 for PepsiCo. Boy, that looks like a pretty big difference, but we'll talk about why in a second. So PepsiCo generated 9.37 cents of net income for every dollar of average assets invested. Higher return on assets means meaning you have a more efficient use of assets to generate profits. Using return on assets, PepsiCo was a lot less profitable in 2019 than 2018. However, this was due to a one-time extremely high return on assets in 2018 due to a one-time tax benefit, the Tax Recovery and Job Act, from the Tax Recovery and Job Act, and not due to improved operations. So if we had looked at operating income instead of net income, the operating return on assets might not have been that different, but this was in 2018 a one-time boost to profitability. It was not that high in any of the 5 years before that either. So here's another way to express return on assets. We can say that it is a product of 2 ratios you've already learned: profit margin from Chapter 5 and asset turnover in Chapter 9. So profit margin is net income over net sales. asset turnover is net sales over average total assets. You'll see that net sales crosses out when you multiply it. But it helps to sort of build this ratio and understand its ratio by looking at the two. So the profit margin from Chapter 5, for profit for $1 of sales, was 10.89%. Asset turnover, net sales over average total assets of 0.86, gives us return on assets of 9.37. In 2018 for PepsiCo, we had a 19.35% profit margin, one-time benefit due to the Tax Recovery and Job Act. Asset turnover was a little worse than in 2018, but given we had a giant profit margin, that overweighed the lower asset turnover to have a higher return on assets of 15.9%. PepsiCo had the lower return on assets in 2019 than in 2018 due to a one-time tax benefit that boosted the profit margin in 2018. PepsiCo's lower return on assets is caused mostly by a much lower profit margin in 2019 than 2018, despite the fact that there's a higher asset turnover in 2019 than in 2018. So even though one of these components was better for PepsiCo in 2019, the asset turnover, it could not overcome the very much lower profit margin. And that is still a good profit margin in 2019. It just was a one-time high profit margin for PepsiCo in 2018. So feel free to use this presentation as a review before looking at other companies' annual reports for the weekly discussion board. I'll also post a PDF of the PowerPoint slides. Good luck and get started, Jaspers.